Welcome to The Explainer. I'm your host, and today we're putting on our seasoned, skeptical equity research analyst hats. We are going to unpack the Q1 2026 earnings of Loews Corporation, ticker symbol LO. Our absolute goal today is to separate the headline hype from the underlying business realities. We're going to act like investigative journalists of financial statements, hunting down the green flags, the red flags, and those deeply hidden metrics that the quick media soundbites literally always miss.
But before we jump into the numbers, we have a quick mandatory disclaimer to get out of the way. Disclaimer, this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
All right, let's dive right in. So Loews Corporation is a massive, diversified holding company, and their market cap is hovering right around $22.45 billion. For the first quarter of 2026, they reported a headline net income of $337 million, which actually is down a bit from $370 million the year before. But listen, in the world of holding companies, that headline number, it's almost meaningless. The real question we absolutely need to answer today is this. Is this giant trading at a discount to the sum of its parts, or is it hiding fundamental weakness just beneath the surface?
To answer that, we really have to unpack the black box. When you break down that $337 million of net income into Loews' four main segments, it brilliantly illustrates exactly why you always have to look under the hood. Take CNA Financial, their insurance arm. Net income dropped pretty significantly, going from $252 million down to $194 million, but then look at Boardwalk Pipelines, which bumped up to $159 million. And Loews Hotels, that skyrocketed from less than $1 million last year to $26 million this quarter. Meanwhile, the corporate segment's losses actually expanded. So, you see, the holding company's total earnings completely mask these massive volatile shifts happening within the individual businesses.
Section 1, Segment Breakdown, The Good.
Let's start by dissecting those shifting dynamics, focusing first on the positive outliers to find the underlying green flags buried in the Q1 data. What's super interesting here is the sheer momentum in two specific segments. First up, Boardwalk Pipelines. They posted an EBITDA of $360 million, completely driven by higher contracting rates and utilization-based revenues on gas transportation. Essentially, their infrastructure is just in incredibly high demand right now. And then, Loews Hotels is an absolute bright spot. Net income jumped to $26 million, and their adjusted EBITDA grew a massive 53% to $124 million. So what's driving this? Well, it's their joint venture at the Universal Orlando Resort, fueled heavily by the addition of 3 brand new hotels that opened back in 2025.
And here is an overlooked green flag that I think the market might be totally underappreciating. $3.4 billion. That is the amount of capital Boardwalk Pipelines has committed to natural gas pipeline and storage growth projects through the year 2030. Think about that. This isn't just a strong quarter. This shows a massive multi-year runway for capital deployment in a highly defensive, cash-generating sector. They are laying the literal groundwork for future cash flows.
Section 2, Segment Breakdown, The Bad. But, as analysts, we can't just look at the sunny side of the street. We have to shift our focus to the red flags that are dragging down performance. Before we hit the exact numbers, let's briefly define a crucial piece of industry jargon, the combined ratio. This is the holy grail metric for evaluating an insurance company like CNA Financial. Basically, it's the sum of a company's loss ratio, expense ratio, and dividend ratio. The math is simple enough. A ratio below 100% means the company is actually making a profit on the insurance policies it writes. A ratio above 100%? That indicates an underwriting loss, meaning they are paying out more in claims and expenses than they're taking in from premiums.
And unfortunately, these are the deep red flags for Loews in Q1. CNA Financial's property and casualty combined ratio actually worsened by 3.8 points, hitting 102.2%. That means their core insurance operation is currently losing money on its underwriting. And on the corporate side, the parent company itself saw its net loss expand to $42 million. This was driven by lower trading portfolio income and notably much higher interest expenses related to some recent debt refinancing.
Let's dig into the footnotes, because this builds a really concerning picture for CNA. Core income dropped to $225 million, but the real story is why it dropped. The underlying loss ratio increased by 2.6 points due to higher loss cost trends.
Even worse, they took a $100 million hit for unfavorable net prior year loss reserve development. Okay, in plain English, this means they didn't reserve enough money for mistakes made in previous years, specifically in professional errors and omissions and excess casualty lines. This is a critical, absolutely critical area investors must monitor, as past underwriting sins are literally eating into today's profitability.
Section 3. The balance sheet. Uncovering the assets.
With the income statement showing this massive tug-of-war between booming pipelines and struggling insurance, we have to pivot to the balance sheet. This is the absolute cornerstone of any holding company's valuation. And guys, Loews possesses what we call a fortress balance sheet. As of March 31, 2026, the Loews parent company holds a staggering $4.5 billion in cash and investments compared to just $1.8 billion in debt. This immense liquidity provides a massive cushion against CNA's current underwriting losses. Plus, it gives them the dry powder to fund future acquisitions, kind of like the $212 million Spire marketing deal they closed at the end of April to expand their natural gas marketing footprint.
To truly value these assets, we need to look at book value, but with a very specific adjustment. We're looking at book value excluding AOCI. AOCI stands for Accumulated Other Comprehensive Income. By stripping this out, we remove the temporary, paper-only volatility of things like unrealized bond losses in their portfolio. This gives us analysts the true baseline net asset value per share of the holding company.
And that adjusted number comes out to $97.20 per share. This represents the AOCI adjusted book value for Q1 2026, which is actually up from $95.89 at the end of 2025. Keep this 97.20 number in the back of your head because it sets up the whole framework for our reality check against the current stock price in just a minute.
But what exactly is management doing with all that parent cash while we wait for value to be realized? Well, they are actively utilizing it for shareholder yield. Alongside their 0.25 quarterly dividend, Loews repurchased 300,000 shares for $31 million during the first quarter alone. Buying back stock is a classic tried-and-true lever to create value. It reduces the share count and concentrates ownership for all the remaining shareholders.
Section 4. Legendary Investors Reality Check.
So, we have the raw data. Now let's run this through the ultimate value investing gauntlet, applying the verifiable facts from our sources against the principles of investing greats like Benjamin Graham. First up, let's look at price versus book. The current share price is sitting right around $109.82. The standard, unadjusted book value is $90.90. So right away, this means the stock is trading at a premium to its standard book value. However, remember that adjusted number? It is hovering much, much closer to the $97.20 AOCI adjusted book value. So while it's not some deep, distressed discount, it certainly isn't trading at massive, speculative multiples either.
Let's tick through a few other key metrics here. Loews boasts a price-to-earnings ratio of 13.45. For followers of Ben Graham, this easily passes his strict rule of looking for PEs under 15. The volatility, or beta, is exceptionally low at 0.59, making this a highly defensive play. Furthermore, the robust, predictable EBITDA from Boardwalk Pipelines creates a fantastic cash flow moat that really helps offset the unpredictable volatility of CNA's insurance payouts. Combine all that with consistent buybacks, and you have a profile that would absolutely appeal to old-school value investors, even with the current pressures on the insurance fundamentals.
Section 5. Moat and Synthesis. The Final Verdict.
All right, we've broken down the parts, analyzed the balance sheet, and checked the valuation metrics. Let's deliver the analyst verdict on valuation, economic moat, and future outlook. Based on the metrics available, Loews appears fairly valued right now. The 13.45 PE ratio represents a definite discount compared to the broader market. However, the stock commands a premium to its $90.90 standard book value. Why? Because the market is clearly pricing in the safety and optionality of that massive $4.5 billion cash hoard held by the parent company.
When we look at their economic moat, we see two totally distinct stories playing out. Boardwalk Pipelines benefits from efficient scale. Their 13,615 miles of infrastructure is incredibly hard and phenomenally expensive for any competitor to ever replicate. On the other hand, CNA Financial relies on intangibles and switching costs through their long-standing commercial insurance relationships. So what is the moat trend? Well, it's definitely pressured in the short term because of CNA's 102.2% combined ratio and those prior year reserve issues. But it is actually expanding in the long term thanks to that massive $3.4 billion committed to future pipeline investments.
Which brings us to the final takeaway for today's explainer.
Loews is a classic sum-of-the-parts story. The pipeline and hotel segments are absolutely booming right now, generating serious cash. But the hidden red flags in the insurance underwriting footnotes suggest a storm is currently brewing for their largest subsidiary. Sure, the fortress balance sheet gives them time, but the underlying business dynamics are totally split. So which side are you on? Does the massive cash cushion and pipeline growth outweigh the insurance struggles? Do your own homework, dig into those filings, and decide for yourself. Thanks for joining me on this explainer, and keep learning.